our research team put together a segment sponsored by Chicago Board Options Exchange, the SIBO, how long to get even. If you had a bad trade over the last 15 years in a strangle or an iron condor, we're only looking at the worst of times. If you made a trade in 2008, in 2011, in 2020, whenever is the worst, whenever we had the fastest meltdown, okay, and you made a trade and it did not work out, it went against you, either.
So we're reverse cherry picking.
We're reverse cherry picking. We're picking out the worst trades in the last 15 years and saying how much money would you have lost and how long did it take to get even? And we're looking at holding to expiration or managing at 21 days. How long to get even? Put this up here. As we've seen in many studies, mechanically trading short SPY premium has performed well over the long term. That doesn't mean it's always done well. Sometimes the market makes moves larger than expected and short option premiums come out worse for wear. Sometimes stocks win. If a trader started their premium selling journey at the most unfortunate time, how long would it take them to be profitable? And how did this depend on their choice of strategy, strike, and mechanics? Do you want to take a guess?
Sure, and it would be a pure guess.
Sure.
I'm gonna say, can I go a little wide?
Just whatever you like.
3 to 5 months. 21 days.
3 to 5 months.
21 days is better than staying at expiration.
I'm going to tell you right now, I will give you another guess. You're too short.
I was a little optimistic. Yeah.
Yeah.
I mean, because you're picking the worst of days.
That's right. You're picking the worst trades.
6 to 9, then. I don't know.
Let's take a look. We used 15 years worth of SPY data, including 2008, 2009, really ugly meltdown, and the 2020 pandemic. We considered 45-day strangles and iron condors using a variety of initial deltas, closing the positions at 21 DT or holding to expiration. We examined the worst times to have started trading these mechanics. We absolutely cherry-picked the absolute worst. We looked at both in terms of maximum drawdown and how long it takes to get back to net profitable. So the first one is we held strangles. This is going to be the worst case. We held strangles all the way to expiration. 50 delta, 40 delta, 30 delta. We tend to be around the 20 delta, not the 10s, but around the 20. And the worst drawdown, now the interesting thing here is for strangles, the drawdowns are almost all the same, which surprised me, around 10 grand. This is a one lot, by the way. This is one contract that you probably at the worst of times collected about $1,000 for, I'm guessing.
Yeah, those losses are significantly more than I had anticipated.
Yeah, these you probably collect around $1,000 in credit, maybe more on the 20 delta, but you lost 9,300 and it took 299 days to recover.
Yeah.
That's a lot.
Very much so.
This is the picking out the absolute worst and how long does it take? Because a lot of people say, hey, you're showing good stuff. Show me the worst stuff. Okay, we're showing you the worst stuff. Like I said, we usually do around the 20 delta and 300 days as it was. It didn't make that big a difference if you did 50, 40, or 30. They were all in that 300-day whatever.
Yeah.
We're going to manage these strangles at 21 days. So these are strangles managed at 21 days. Now you'll notice here, the difference is you essentially eliminate the outlier risk. That's why we manage at 21 days. So the worst loss goes from selling something for $1,000 and buying it back at $9,000 to selling something for $1,000 and buying it back at $3,000. That's significantly better. All of these numbers are way better than the worst drawdown, managing at 21 days. But the time to recover does not improve.
Yeah, no, it doesn't.
Because you make less money. That is one of the most interesting stats that I pulled out of this, was that the time to recover did not improve here, but the loss went way down, managing at 21 days.
And I mean, I think when you're thinking about like how you recover from something, you obviously want to have a less of a loss, right? I mean, even if it takes basically the same amount of time.
Yeah, sure, of course. Yeah, I'd rather recover from a $3,000 loss over a year than a $10,000 loss.
Right. Even if you get back to zero, same thing, right?
So we decided to look at iron condors. Now with iron condors, we tend to be in the 30-15 range. So the third one, second from last, that tends to be our range. 30-15 is probably the most likely. And again, this is a pretty wide iron condor. Those aren't strikes, those are deltas. So But the biggest loss in this case was $1,900. So assume it's probably at least $20 wide. Maybe it's $25 wide. Who knows? No, it's probably 20. Well, I can't tell exactly. Let's say it's over $20 wide. So the worst loss was 1,900. In most of these cases, the worst loss is about the same. And the time to recover here was, 224 days. If you did the bigger iron condors, it was even took longer to recover. So that 30-15 was the smoothest. This is holding iron condors, though, to expiration. We tend not to. We tend to hold iron condors only to 21 days and then roll them. So rolling iron condors at 21 days. Now, this was the one that surprised me the most. The 30-15, which is the one that I do mostly, you only lost $1,300 was the worst loss, which is not that bad. But it took 644 days, 2 years to recover from that. The other ones all took a long time. Recovering from iron condors in the worst of situations, the 2010, you're still in the red because the credit you receive is so small. I mean,
you're not. I mean, this is you're not going to do this.
No, I understand. That basically is it. You're not going to take your worst drawdown on an iron condor and come back from that in that particular same iron condor, because these numbers are interesting to me. Naked short premiums traders are at risk for large losses. Over the recent decades, however, if they stuck with their mechanics, they would have recovered in slightly over a year after reaching their absolute worst point. And remember, your absolute worst points only happened 2 or 3 times in 2 decades. So this doesn't happen very often. Right. Letting strangles run until expiration more than doubled your worst realized losses compared to managing at 21 days. Again, proving that 21 days is your number. But thanks to larger credits, they also recovered from their worst losses slightly faster. Defined risk trades involving significantly smaller drawdowns and require much less buying power, the smaller credits held the recoveries back. Of the strategies and mechanics considered, only the far out of the money iron condors managed at 21 days would be in the red at the end of the day. So trading short premium means being exposed to risk. Hopefully now you feel better equipped to evaluate how much risk is right for your portfolio. The takeaways from this are really fascinating. In the worst of cases, you're probably not going to recover from like a really bad max loss iron condor at 2015. But again, these are absolute worst cases.
A good study, good thing to look at, because everybody always worries about the things that can go horribly wrong. And here you have a nice example of that and what to expect.